Welcome, everyone. My name is Loreen Gilbert, CEO of WealthWise Financial, and today is July 17th, 2024. We are here today to go over our mid-year outlook. Hard to believe the year is halfway through, and a lot has been going on in the stock market and the bond markets as well. So we're here to give you an overview of what we've seen year to date and looking ahead as well. And to make this presentation today, we have John Milligan, our Director of Investment Strategies, and Carissa Adams is here, our paraplanner at WealthWise Financial. And at the end of the presentation, Carissa is going to make an announcement as well. So with that, John, I'm going to turn it over to you, and then I'll be making comments as you're going through our mid-year presentation.
Wonderful. Can everyone hear me?
Yes.
Perfect. I'm going to go ahead and share the PowerPoints. And all right. Can you see the PowerPoint?
Yes.
Perfect. All right. I just need to move things around a little bit so I can press the play button. Okay. There we are. How does that look?
Great.
All right. Perfect. So we're going to go ahead and hop into the first slide here. And the first thing we're going to talk about is equity valuations. So here on this chart, which is a little bit busy, but we'll touch on each line. These are PE ratios. PE ratio is probably the most oft-cited valuation metric. So it's essentially, are stocks expensive or are they cheap on a price to earnings basis? So you could say a PE of 20 means that you got to pay $20 for every dollar of earnings that company is generating, higher being more expensive. And so what we're looking at here is we're looking at three indices and then kind of like a little ad hoc indice there in pink. The three main indices we're looking at is the S&P 500, the one everyone knows. S&P 500, as not everyone knows, is large companies. So it's 500 large companies. But they also have two other indices. They have the S&P 400, which is mid-sized companies. And then they have the 600, which is small companies. And so we're looking at all of these in comparison over time. And what we're looking at right now, if you go to the far right side of the chart, is you can see that we're at a big disparity between large companies and small companies. Now this isn't what we would call a normal circumstance. It's not like over time it's normal for large companies to be running at much higher valuations than small companies. And typically this is something that you would expect to revert or get back closer to one another. So for them to get back closer to one another, you're going to have to see one of four things. Either the price of the large companies needs to come down while their earnings remain the same, or the price of the large companies needs to remain flat while the earnings go up. Both of those situations don't really speak well for the price of your large cap stocks for going up, or the price of small companies needs to come up while their earnings remain flat. Or the earnings of small companies need to plummet, which looking at the way the earnings have been for them recently, it's not likely their earnings would drop while their price levels stay same. So, when does this typically happen? Well, if you look back over history, it typically happens in recessions. This is where they really get close together. If you look at the gray shaded areas in recessions, this is what brings them together. The time where these were most spread out like they are now was the dot-com bubble. So if you look to the far left side of this graph, you can see that the red line is far above the green and blue, which is the small and mid cap. And then as we got into a recession, the small and mid cap actually started to construct on their valuation ratios and the price started going up while this large caps kept going down. They got kind of in a closer equilibrium over time, but the pink line, which is the extremely large big tech companies, you can see their PE ratio in pink has exploded over the recent 5-10 years, which has helped levitate the S&P 500. So draw an equivalency to dot-com bubble. It's not quite equivalent. We don't see it that way because earnings are stronger, but we are investing in companies that we think earnings are pretty well diversified. We think companies like Microsoft and a few others have pretty well diversified earnings, but we do think that there's opportunities in small caps. So here's a breakdown of small caps. When we talk about stocks, we talk about two main flavors typically. One, those of value. So value companies are companies that are bought at cheaper valuations and typically considered to be good deals. Whereas growth names are companies where it's expected that their earnings is to grow by quite a bit. And when their earnings grow by quite a bit, then their prices tend to grow with them. Over the long run, the one main thing that correlates really well to stock prices is earnings. So in the short run, headlines, random things can change a stock price, but over the long run, you really want to be investing in companies that are going to grow their earnings or be bought at really cheap valuations. So what we can see here is that the small cap names that are values, that's the green, those are the ones that are truly deep bargain values right now. And we're starting to see a little bit of market rotation into these names. So for example, last week, when the CPI data came out, the stock market had increased by, well, the small cap stocks had increased by about 3%, but the small cap value stocks had increased by more like 4% at that point in time. And it's a little bit, we're seeing a little bit more market rotation into value, and some of these areas have been beaten down. And so over the past week, the index for small caps has outperformed the S&P 500 by the best in about a year.
So just to recap here, John, we see a little bit of a rotation that's happening in the markets. Even today, we've been seeing what's going on in semiconductors and whatnot. And I know you'll get to that, but this speaks to the idea of the markets making a shift, making a rotation, and perhaps that area that we've been waiting for in the small cap markets finally making headway. We've been seeing for a long time now that the valuations, there was a big disparity between the valuations of small cap and large cap, and now we're actually seeing some movement in price.
Yeah, absolutely. So that rotation is coming, and the catalyst for it really seems to be when the market changes their expectation for Fed rate cuts. So the data last week pushed up market expectations for the first rate cut to come, really high probability in September. And when that change was made, we saw the biggest price impact to the small cap value space. So if you think in terms of large, mid, small, value, blend, growth, the greatest impact happened to small cap value. So the market, which has heavily discounted this area, really seems to be willing to bring it back up on the back of rate cuts.
Perfect.
So here we're going to talk about another thing, and that's really kind of within the whole space of value investing from value to growth. There's been a lot of studies that have shown, how you should invest in this space. When we entered into this year, and we can, refer you back to our presentation at the end of the year, one of the things that we noted was that we were going to keep at least a market weight in small caps, which we have. We've actually been slightly overweight in small caps, but one of the things that we were going to do was we were going to invest in small caps on a quality basis. And so what that means is when you invest in or when you invest in value companies, particularly in the small cap space, you can find what are called value traps. And these are companies that are just trading dirt cheap. They could have a PE of 3, 4, 5. And it's like, oh, why would I not invest in a company that's generating, $1 every, or it takes basically 3 years for them to generate all the earnings back to the price I paid into it. But these are value traps for a good reason. That means that there's something going on with the company that's, could cause some long-term issues, could be legal issues, could be their market drying up, things like that. So we focused on investing in smaller companies that were of higher quality. Whereas if you look at the Russell 2000 index for small caps, at the end of last year, it was about 50% allocated to profitable companies. Our allocation of small caps were more like 80% or above into profitable companies. And it's shown quite well this year. Our small cap value position is outperforming its small cap value benchmark by about 5%. And our small cap growth benchmark or small cap growth allocation is outperforming its benchmark by about 15%. So they've both been doing much better because the market is rewarding value at this point in time. So here we have something called the Shiller PE. That's what it's also known as the cyclically adjusted PE ratio. And essentially what it does is it adjusts earnings over a longer period of time, not just based off of more recent earnings. And what it does is it gives a good kind of like cycle agnostic look into how the company is being valued. And so the CAPE ratio was something that Dr. Shiller used to correctly argue that stocks were overvalued during the dot-com boom. And so if we look back over the history of the Shiller PE, which this is being applied to the S&P 500. So it's being applied to those small or those large companies. As you can see right now, about a 35 times Shiller PE. The only other times when it's been this high was Great Depression, dot-com boom, and 2021, which was followed up by 2022, as we all remember. And so this draws upon a little bit of caution. And, it's about this time where we start to, the market can continue to have a run up, as you see. I mean, you can see where we're at right now at 35, and the dot-com boom, it went as high as, high 40s. And so, you could say, I'm going to, make changes now, but the market can continue to run up a little bit. So really, this is just a time to take some gains and look for quality, which is what we continue to do. We're looking for companies that have resilient earnings and aren't overly valued. So whenever I mention names like Google and Microsoft, things like that, these are companies that we don't see being too overly valued, but there are some out there which we are staying away from. So when we get into this next, for Q2, companies are about to start reporting earnings. And we think that there could be a catalyst this year for the valuations of the large caps to start to get trimmed off a little bit. And really, it's going to come down to any of these large companies putting a little bit of pessimism out there in their earnings call, missing earnings, cutting guidance, et cetera. But what we want to highlight here is that the consensus is for an 8% year-over-year growth for the S&P 500 earnings per share. So there is an earnings per share figure that's quoted for the entire S&P 500. So one share of the S&P 500, there is an entire EPS. And so it's expected that the EPS change, that 8% from the Q2 of 2023 to Q2 of this year, is supposed to represent $3.88. And on the right here, we've got a table of what the EPS change is for several large companies. And as you can see here, this is meant to illustrate the weight that these companies are going to have. If the entire index is expected to grow at $3.88, well, Merck Pharmaceuticals is expected to grow at $4.16. Last year, they had a big adjustment to their earnings. It was a one-time adjustment, but they're at a negative $2 and some change. And now they're expected to be at a positive $2 and some change for a difference of $4.16. So that big jump is going to have a big weight on the S&P 500 EPS. Meta, which is coming off of a down year, they lost a lot of advertising sales in 2022, and it's taken them a little time to pick back up. They're expected to grow by almost $1.50. And so they're going to have a lot of weight on this factor. Eli Lilly, which has been growing with some of their recent drugs, is expected to grow at $0.50. So any one of these companies can have a major impact on that over $3.88. The blocks you see to the left is meant to represent scale. So the entire grouping of blocks is meant to represent $3.88. And as you can see, the rest of the S&P 500 compared to all these other names is a minority. So they can all have such a dramatic impact, and we'll be watching all of them very closely. So on to the next part, which is a topic that people are going to continue to bring up, is the AI investing opportunity. And we have listened to lots of experts, we've discussed with lots of experts, et cetera. And the AI investing opportunity is essentially going to come, as we see it, in 3 phases. So the first phase is essentially building out whatever AI is. And so you've heard names of companies like NVIDIA. NVIDIA started in the 90s as a company that builds chips essentially geared towards playing computer games, but they discovered that the chips that are good for building out those 3D models and matrices are also great for building out these AI models. And so there's lots of areas in the semiconductor space that there's going to continue to be great opportunity. But it may diffuse out into other players as the area starts to mature. We're investing in utilities right now on the AI infrastructure build out, because right now utilities have really optimistic growth priced in and projected over the next year. So we've had a pretty good run on utilities relative to how that sector has performed historically, because there's expectations that there's going to be more energy demand and need. And then, software infrastructure companies, the cloud companies, are going to be making connections between, those that are, developing AI and delivering it to customers. So as you can see at the top, we have kind of in the middle space. We're between the AI infrastructure build out and the delivery of the products, because you can't simply just build AI. You have to make money off AI. It doesn't matter if we just simply build it. So, you got companies like Meta and Google and all these other large companies that have spent tens of billions of dollars in buying out the GPUs and other infrastructure required to build their AI products. But all of these executive teams, they all answer to shareholders and board of directors, and they're going to start asking the question, okay, you've invested tens of billions of dollars of our value. When are we going to start to see something out of this? You see a change in revenue. And so that's what we expect the markets to really start to ask questions about over the coming quarters on earnings calls. You've spent all this money developing all these AI products. How are you going to commercialize them? And so, Apple's already started talking about how they're going to bring on-device assistants with their iPhones, which is going to cause a whole new upgrade cycle. Google's looking at doing something very similar, getting their AI assistants penetrating a lot of different products. And, Microsoft with their Copilot and other things. So they're all working to try to figure out how to commercialize these items. And as we've seen, like from the 1990s, Yahoo was the first major browser. They're out 4 years before Google. But Yahoo sold for, I think, $5 billion, where Google's now worth over $3 trillion. So, there's going to be some players here that do great, some that aren't. And so, we're going to be invested somewhat broadly, and but still allocating to some names that we like. And then lastly, we think it's going to get to a point of existing capital improvements. There's a really interesting study that was put out recently by, I believe, JP Morgan, that was, something like the steam engine took 68 years for it to have an impact on the economy overall. Electricity from its discovery to implementation took something like 30 years. The internet, I believe it said, took something like 15 years. And so they're saying it's basically like half. And now they're expecting that for AI to really start to become, prolific and have its impact all over the entire economy. We're looking at about 7 years. So we could be looking at anywhere from 3, 4, 5 years where AI starts to have a dramatic impact on how the entire economy works. So we're looking at biotech companies discovering drugs much faster, industrials companies automating with robots and other things. And so, this is how we see this whole entire thing playing out and how we're trying to allocate for it.
Yeah, I just
But going back,
let me just add back. Yeah, just add back here. So like John was saying, we're still really in the infancy of AI. And now it's time to monetize what's already been done in that first box there. Still, there's all this build out that's continuing to happen. And now we can look at also, how are these companies going to monetize it? So we're focused all across these 3 different boxes, in a sense, of looking where we are now, semiconductors, utilities, all the software infrastructure, all of that, plus the idea of monetization. We have a number of holdings that we're looking at in this area, like communication services, information technology, and then also on that third area, specifically in the area of industrial. So we're investing all along, as we know that there are going to be these opportunities, and these companies are going to change dramatically over the next decade.
Yes, absolutely. That's perfect. And then, so if we go back to that first stage, the build out, because as today was not a great day for semiconductors, but semiconductors have had a great year. And so we don't try to, build out our idea of what an industry might do by ourselves. Like I mentioned, we do go out to lots of experts, et cetera. And so this is a wonderful chart put together by the people over at Altimeter, which is a technology-focused investing fund, which, I like companies like ARK, but they're very moonshotty, more like a venture capital. These people are very down to earth, trying to understand the business cycle, the business economics. And so they have this chart here of accelerated data center build out. So data centers are essentially a sub-industry of real estate that was Nareit created an index for them in 2015. Since 2015, that index, though it was really hot when it first came out, it's underperformed the S&P 500 because data centers are kind of a commoditized product. Really, it's the companies that are piling into the technology within data centers And so now we have this whole new industry that's going to revitalize data centers. So on this chart here, 2024, they're expecting data center investment to be about $300 billion, with the gray part of that bar in 2024 being for the kind of the classical stuff that data centers have been: storage, CPU, those types of things. And the green parts, or the blue part, being new inputs of accelerated compute. So this is the stuff that's going to fuel AI. And what we want to draw on from this chart here is that the expectation is that this is a area that's expected to grow by more than double by 2028, with a lot of that growth coming from accelerated compute. So this is going to continue to be names of companies like NVIDIA, like Advanced Micro Devices, like Teradyne, companies providing support in lithography like ASML, et cetera. So this is still an area, even though today was a bit of a rough day for semiconductors, still over the longer run, we see some really great opportunity here, which is why we're going to remain in the build out space in some of our investing, but looking towards that second phase for companies that are going to monetize really well. So here we just want to kind of hit on one thing, and it's the idea that our Fed rate cut's going to be a boon to equities, and really it depends upon the economic situation. Really, we do see Fed rate cuts as going to be a good boon for bonds, particularly high quality bonds, which tend to be good during recessionary periods. So we are allocated to high quality bonds a little bit more than our benchmark, because we like that space. But as far as the equity boon from it, it really depends on if a recession is going to occur within 6 months. So here you can see it's in numerous years where we had Fed rate cuts. What was the subsequent 6-month return of the S&P 500? And really, the return is dependent upon if there's going to be a recession in 6 months. In 2019, the 6-month return, it actually that 6-month period happened in February of 2020, right before everything kind of fell apart with the COVID pandemic. But generally, the rule is are we going to be in a recession or not? So looking at that,
let me add one more thing,
sure.
John, to that, if you go back to that slide. So the reality is that the Federal Reserve usually does their rate cuts as the economy has already weakened substantially, and we're headed directly into a recession. And that's oftentimes why you see this. This time, they're not necessarily lowering rates as a direct result of knowing that we're going in a recession. They don't know that. We know our economy has been softening. We know that unemployment has been going up, but it's not the same as some of these other cases. So we don't know, and a lot depends. We'll see what happens, policies, and we'll talk about policy, et cetera. But I will say that this time the Federal Reserve is not necessarily lowering rates in relation to the economy being in just a terrible condition. It's more of a result of the tightening that has been so long, that is constricting and is restrictive. And now it's time to kind of loosen that up. So they've actually done quite a good job during this. I mean, they started late, fault them for that. They started late in the rate hikes, and then became very restrictive. And now they're realizing, okay, they've held on. It's time to start loosening that up.
Yeah, when I reviewed all of these cuts over history, this feels a bit like 1995. Could be 2001, but it looks more like 1995, where what the Fed's looking for is what they call a sufficiently restrictive rate policy. And they, right now, inflation is running about 3%, and the federal funds rate is over 5%. So that gives us a more than 2% delta of rates over inflation. And so the Fed is just saying that as rates approach their as inflation approaches their 2% target, they don't need 3%. That 3% of restrictive policy is just not necessary. So that's really their current reason for looking at cutting rates.
Yeah.
So here we do keep an eye on some things, and there is some signs of economic crack. And what this is something referred to as the SOM rule, and it's kind of like something that economists talk about a lot, but you don't see a lot in publications of mainstream media or things like that. But what it does is it's saying that the rule indicates a recession when the 3-month moving average of unemployment, so the most recent 3-month average of unemployment, is 0.5% higher than the lowest 3-month average over the past 12 months. And so once it hits that 0.5%, that's when they say the Somme rule triggers and that we should be looking out. And so right now, currently at 0.43, if I've highlighted some spots over history where the Somme rule got high but didn't trigger. So in May of 1986, it went 0.33 up. In 1967, 0.47. So doing the math, we see that if the unemployment jumps from its current of 4.1 to 4.2, that will take the Somme reading to right at 0.5. So this is one area that we are keeping a close eye on. The unemployment rate, it really is like a behavioral finance thing. When consumers start to see the unemployment rate tick up, it kind of becomes a "is it coming for me" situation, and they start saving and they stop spending, and that could kind of drive us into a recession. So definitely keeping an eye on the unemployment rate. So talking about the consumer confidence right now, just wanted to highlight that it's not in the dumps, as a lot of people might have the impression that it is. It's just sitting right on that dividing line. So when we look at the consumer confidence index as provided by the Conference Board, above 100 is considered good, below 100 is considered kind of souring, and right now we are sitting right around that, just above that 100 level. So the consumer is spending. We just got some recently surprising retail numbers, and so I think it's going to have a lot to do with upcoming unemployment readings. So now we're kind of look internationally and highlight some stuff. We are slightly underweight international, and a lot of where we are investing internationally is in growth and in hedge positions. Talk a little bit about why. So Europe is not necessarily a monolith, but all these companies are heavily interdependent upon another for economic and or for their economic situation. And so looking at some of these, Germany, which is nearly 25% of the EU GDP, no secret to anyone, 10% of their exports come from cars. Their car exports are under pretty serious threat from China. That little graph you see there, that shows the manufacturing competitive index, and you can see how Germany has been dropping pretty substantially in recent years, and China keeps trying to build up. And so there's a pretty strong threat. I read in a Commerce article recently said that Germany is looking to supplant their auto industry with agriculture. It's like, okay, so you're going to replace a high-tech, high capital intensive industry with like basically one of the oldest industries known to man. Like, that's not going to go well for you. The UK, which is 15.2% GDP, recent report from their National Institute of Economics and Social Research shows that they're only expecting their GDP to grow by below 1% annually all the way through 2032. So that's well below their pre-2020 trends. And France, which is about 15% of Europe's GDP, as we recently saw, Emmanuel Macron had to get in bed with some pretty left-leaning parties to group together to beat out the Le Pen's party, and so now they're already coming up with proposals for much higher wealth tax and other taxes as well, and there could be a little bit of a capital flight there. So there's a whole basket of reasons why we're not super optimistic on Europe right now.
Yeah, I just want to add in here, Europe is a great example of what has been a value trap, because when you look at valuations and you compare European valuations with our valuations, it looks like they are so much better value. But
yeah,
and they are, but there is a reason. So this goes back to what John was talking about, value traps and making sure. So while we may pick certain companies that are global companies that might, maybe a company is based somewhere in Europe, we're not so much interested in more of a broad-based exposure in Europe, and more interested in Japan is where our investment has been. John, you can explain that.
Yeah, absolutely. And just in Europe's just a hard place to do business anyway. If we see the economy of Europe turning around, one of the places we often look is just American-based companies that sell a lot of products to Europe. Like if their economy is going to pick up, let's just find a U.S.-based company is going to sell a lot of stuff there. Yeah, because it's not super friendly. If you look at the S&P 500, the 10 largest companies, Google, Facebook, like these companies were all formed like in the past 20 years. And you look at like the top 10 largest companies in Europe, and they're old, like Louis Vuitton and stuff like that. It's a hard place to really see a lot of growth. So continuing on the economic cracks, one place that we don't really do a lot of investing in, we have one mutual fund where the manager has maybe 20% in China, but very good manager, done quite good work there. But broadly, we're not super optimistic on China. China is an economy where a lot of their assets, unlike in the US where we put so much assets in stocks and bonds like that, they put so much in real estate. And so on the left here, you see the growth of their residential mortgage market. And on the right here, you see how their property values have done over recent years. And there is something akin to like the 2008 US situation kind of percolating over there in China. There's been 40 banks that have been sort of forced to be absolved or taken up by other banks. There's been Jingxi Bank. There's a really interesting photo of people right at the front of their headquarters because the bank shut down, not to get their money out. A lot of some toxic asset concerns in China, and so because China's become a more prominent global player, this could have a little bit of ripple effects. But we are allocating. We're not allocating prominently to companies that are heavily focused on the Chinese consumer. We'll put it that way. And then finally on Japan, so Loreen highlighted Japan. We do have a very direct investment in Japan, and Japan's been an interesting situation for a few reasons. One is, as you can see in this chart, their exports have been growing. So Japan has been a great export story for a long time, but then they've kind of gone through the Japanification, their stagnation, et cetera. But in recent years, their exports have grown. And one reason for that is that the yen is weak. So when the yen weakens relative to the dollar, that is easier for them to export out product. And so the same source for this information here also provided their projections. And so from a current level of under 9,000, they expect it to grow to 10,000. This is in billions, by the way. 10,000 billion JPY in 2025 and 11,500 billion in 2026. So as long as the yen remains weak, we do project their exports to grow, which is correlated with their economy and markets overall. But not just that, also tourism is starting to become a bigger boon for Japan, and they're becoming more shareholder friendly, where over the past 20 years, they've been more stakeholder friendly, focused more on how the businesses could affect their local community. Now they're asking the question, how can their businesses benefit shareholders more? So these are some reasons why we like Japan and are invested there directly. And here we're going to touch on geopolitical hedge. So this is an index that is cited by officials within the Federal Reserve, and it is essentially capturing what they think the geopolitical risk is. And it's an interesting index construction. Essentially what they do is they scrub headlines in newspapers all over the world. They look for certain words, and then they overlay it with essentially relations between countries, friendly or not friendly, and they generate out this geopolitical risk index. And so right now it's slightly elevated. We think that leading up to the election, there might be a little bit more geopolitical risk. And so this is the reason why, not the only reason, but a prominent reason why we're investing in something like energy, which was pretty good today. And then also why we're having a bit more of a domestic bias. And then here, this is a chart from the economists at LPL. And what this is highlighting is an alternative investment idea. So alternative investments are, they really work well in their period, and they're good tactical investments. And so what this is highlighting is a strategy called global macro. And so global macro is a hedge fund style strategy that looks to take advantage of essentially global macro trends. Those could be trends that are currency trends. They could be trends that are, investing at an interest rate in one country and then allocating in another country. And so what the research shows is that in periods of high dispersion of central bank policy rates, so central banks, we have the Federal Reserve in the US, they have the ECB in Europe, all over the world, there's all these central banks that are setting their policy rates. We have a dispersion where, it's particularly high in some countries and low in others. This creates opportunities for these global macro funds. And so right now we're allocated to a global macro fund that's seeing lots of opportunities in taking leverage from some countries and some currencies and allocating it in bonds and other from other countries. And so this is one area that's we believe that we'll be stuck or that we'll be working with for the rest of the year. And then let's go ahead and we'll move into fixed income. So as we noted on the fixed income side, we've been the same for quite some time, which is high quality and around market duration, slightly above in some cases. So what we want to show here in this graph is the dark blue line is the effective federal funds rate. And you can think of this as a proxy for money markets or CDs or anything like that. A risk-free rate, as they sometimes refer to it. And what we're trying to show here is that as you get into 2025, this is based off of the CME Fed futures, and this is the market projection for rates. So right now, as you can see, getting a little above 5%, 5.33% on the federal funds rate. And that is expected to drop to close to 4% by the middle of 2025. So about over a year. So your investment in money market a year from now, you'll be earning about closer to 4%. But with bonds, with duration, you can lock in the yields now. And so what we're showing here in these others is that's the effective yield for corporate bonds from 3 to 5 year, 5 to 7, 7 to 10, 10 to 5. Take your pick. This isn't purely income. This isn't the coupons. It's the coupon plus the expected bond price appreciation as they mature. But the majority of it would be the coupon payments that come out on a periodic basis. And so what we're trying to convey here is that money market rate is expected to continue to slide even past 2025. So you could ride that slide down, or you can lock in income levels now. And also, once the Fed does start cutting rates, that price component of the effective yield will start to go away really quickly.
And so what John is saying here is now is the time to lock into those yields, making sure you're not overly invested in money markets. Certainly money markets have a place, savings accounts have a place, liquid emergency monies, but many people have overly put money in those money markets. And now is the time to get into those bonds where you will see as the Federal Reserve lowers rates, you'll see a bump and then continued coupon over the next 5 years or so. We expect to be elevated, and that combination is very helpful. So we are excited about bonds, and there's not a lot of times when we are very excited about bonds, but certainly now is that time.
Yep. And then, so then we talked about keeping the quality high, keeping the quality high. And so why not high yield bonds? Because high yield bonds are a category that's where you can get a little bit of a higher yield than the investment grade bonds. Well, on this chart, what you see here is this is the high yield option adjusted spread. And as you can tell from the far right over there, it's really tight. So over the high quality portion of bonds, you're not getting a whole lot of extra yield. So we're not necessarily in the camp that we are going into a recession, but it's always a possibility. So why are we going to stretch for just a tiny bit more yield whenever we do get into economic situations that aren't optimal? These high yield bonds can sometimes act like equities and see the prices fall. Not something we're interested in for just a small amount of extra yield. We will stay generally away from that space. And then we're going to kind of wrap up here on mortgage-backed securities. You've probably heard us talk a lot this year about being invested in preferred securities, which has done great for us. Those are relative to bonds in general. Those have done really well and benefited our bond portfolio by quite a bit as the market has been in a wait and see with the Fed cuts. But mortgage-backed securities is another area where we're allocated a little bit more than our benchmark in general. And one factor with mortgage-backed securities is that they can sometimes see prices fall once you get this risk of prepayments. So people are investing in mortgages, mortgage rates right now, 7.5%, 8%. And then so that locks in the mortgage bonds. But what can happen is that as the mortgage rates fall, people can refinance, and essentially their mortgage bond goes away, and in its place goes a mortgage bond with a lower rate. And so that can have some price consequences on mortgage-backed securities. But looking back, recently we read a white paper, we did some research, and really the prepayment risk doesn't really rear its head and become a big factor until the prevailing mortgage rate on new issuances gets really close to the average outstanding mortgage rate. And if you look at the pool of mortgages that are out there right now, so many of them were originated pre this interest rate spike back in 2020, 2019, et cetera. So many mortgages were refinanced at that time. It's one reason why we have supply constraints now, but also it's keeping the average around 4%. So we've got a pretty good buffer right now where we can stay invested in mortgage-backed securities, get a decent yield, not be that worried about the price risk, and not really have much duration risk either. So this is going to be an area that we're going to continue to stay in because we don't see much of a concern with the prepayment risk. Oh, we'll get back to that. And then this is just kind of on a going forward basis, just to wrap this up. But we're going to continue to be long some large growth names. Like today, we could see some volatility. We're going to have to make sure we're focused on earnings quality. But we think that the market potential for AI remains strong. This just could be like part of the cycle where it's taking a little bit of a breather. But we do see a potential need to shift on the horizon. And we're going to continue to be looking for companies that are going to be able to monetize on that AI. And we really enjoy talking about those names individually in our meetings with you. Also, as evidenced by CP9 numbers released on 7/11, a subsequent 3.6% rise in the Russell 2000. Rate cuts or the expectation of is showing itself to be a boon to small caps, but we're keeping our quality high. We're not looking for any value traps. Like we mentioned, global dislocation can provide opportunities for global macro strategies. We've made a lot of investment there. Geopolitical risk continues to be an argument for domestic bias and energy exposure. And then lastly, on our fixed income allocations, we're going to continue to be moderate in duration, locking in single-digit income levels and keep quality high. But we're also using MBS and preferred securities to give us increased yield while we wait for the realization of those Fed rate cuts to give us that price spike on bonds, which we haven't seen yet year to date.
Thank you, John. That's great. Great overview. And we're going to take some questions here in a minute and see if anybody has any questions. And while we're waiting for those questions, John, I'll go to you for a minute to say, what is the market pricing in right now as far as recession? What probability right now is being priced in?
Let's see. So there's different ways to measure it, but one of the most common measures, which is kind of strange that I don't know that it's working perfectly, and I'll say why. But one of the most common measures is to look at the yield curve. Look at the yield curve inversion, and so right now it is currently projected. So our current date is this one. And so it's currently high. It's projected about 50%, but a lot of that has to deal with the yield curve inversion. And this is one of the things that I often like to note is that Yield curve inversion is when the yield on longer dated bonds is lower than short dated bonds. So in the bonds market, yields build on each other. So there's typically a short duration, low risk yield. So that's like if you go to somebody who's got extremely high credit quality, it's like, hey, can I borrow $1 for a day? How much do you charge them on yield? That's the theoretical lowest level. And it's like, okay, no, I want to borrow that $1 for a year. Well, that's adding a duration spread. So they got to borrow at a higher interest rate. Oh, my credit quality is poor. I got to borrow at a even higher rate. So it all builds up. So it's unusual for longer dated debt to have a lower yield than short dated debt. And the reason why the bond market does that is because people are buying into longer dated debt on the expectation that the Fed's going to cut rates. And when they do cut rates, that drives the price of longer dated debt up. And so the yield curve inversion has always looked to be a sign of recession indicator because of the Fed cutting rates typically into a recession. But as we showed in that one graph, that's not necessarily always the case. And when you listen to the Federal Reserve right now and you listen to Jerome Powell, he's actually saying that the economy looks really strong and that they are looking to cut rates, but it's not because of recession. It is because of that. Sufficiently restrictive rate policy being, a couple percentage points, which they think is more than sufficiently restrictive. So it's just something we got to keep our eyes on. Like I mentioned, I'm firmly in the belief that the unemployment rate spiking can really cause the U.S. consumer to pull back. They're 70% of the economy. As soon as they start pulling back, people start calling their suppliers and cutting back orders, and then they start cutting back, and it just becomes a snowball effect. So we're going to keep a close eye on it. But as far as recession probabilities go, I wouldn't suggest that one is the most reliable.
Yeah. Any questions, Carissa? No. Okay. One other thing that I want to mention, because this is on everybody's top of mind right now, is just the election. And in our one-on-one, we're actually going through a presentation that goes through history with elections and also policies and the difference with candidates and what we might see as far as investment themes, depending on who is elected. So if you have any questions about that, we have another presentation to go over with you one-on-one as well. And with that, as always, we are here for you to meet with you, to answer your questions, to help you personalize your financial plan and your investments. So please let us know about meeting with you. We always reach out, but we also appreciate when you reach out to us. It's both ways. When you want to talk and when we know we need to talk to you. So please reach out to us as far as any kind of updates that you would like. And with that, John, any final thoughts?
No, like just, really happy to be in front of everyone today, and, have really enjoyed our interactions with everyone so far year to date. So I really look forward to interacting with everybody for the rest of the year, and hope everyone's having a wonderful summer.
Right. It is summer. So hopefully people are taking some nice vacations and doing some fun things. And so we look forward to seeing you either virtually or in person very soon.